Ryan, how you doing today?
I'm good. How are you?
Doing good. I'm looking forward to hearing your stories on the show. You've got some really interesting things that you've done in your past as you've become an entrepreneur and the different ventures that you're involved in, which are quite a few. And you've got a lot of different pieces of wisdom I think we'll be able to pull out of you. But for the listeners that aren't aware of some of the things that you've done, can you maybe give us, let's start at square one. Like, how did you become an entrepreneur, and did you know that you were going to be one, or was it an accidental situation? And kind of give us back to square one.
Yeah, sure. So I didn't know I was going to be an entrepreneur, but looking back on it, it was unquestionably like a natural path. I was really always hustling. I had jobs from the time I was 15. My first job was watering plants in Nashville, Tennessee, and I would work at a plant store and I would sit out in the hot sun in the summer and water the plants. And that was, I was just always hardworking. So I always had jobs. And then I put basically through high school, I would just work various hustles, whether it be making and designing, drawing T-shirts and selling them, or sort of like running your type of lemonade stands. I always naturally thought you had to make money. It was like, you got to figure out a way to make money. And so you can, for me, it was like, I can, go out to dinner with my friends and I can have a milkshake or like whatever. I could put gas in my car. I didn't have to ask my parents for money. I mean, they definitely supported me, and by all means, they were wonderful, and I had a great education and everything. But in terms of like getting cash, I never really wanted to have to turn to them. So I was just always doing one thing or another, and it sort of naturally led me. At one point, I became an accountant, a CPA, and didn't really love I was an auditor, actually at PricewaterhouseCoopers, which is a great firm, but I didn't really love for myself being an auditor. And I ended up falling into media. I became an accountant at a media company, which is best known as WireImage. And it's WireImage, WireImage.com, and still around today. And when that company grew and I ended up getting bought for $200 million, and I was fortunate enough to have had a common stock option grant as an employee. And I also had invested a little bit of money into their Series C round. So I made some money as an investor. When I saw the founders of that company, who are still advisors of mine to this day, I saw them get very wealthy. Like an aha moment. It was so bizarre. Like, no one ever told me. I wish someone had told me it. Either no one told me it, or I didn't listen. One of the two. It doesn't matter. But no one ever told me simply. They all they had to say was this. They should have said, a wiser person should have said, hey Ryan, did you know there's really only two ways to be wealthy? And I would have said, no. Like, you can be a doctor, you can be a lawyer, you can be a NBA basketball player. There's a lot of ways. And I said, no, there's really only two ways. And one is you can inherit money, and that's not a game plan. And that wasn't my plan. And two, you can do it through capital gains. And capital gains, more specifically, is done by founding a company with literally nothing, starting at zero, couple of dollars invested, whatever it might be, and eventually growing it into something very, very big and selling it. And your stock in that company is, the gain on your stock. And so being an entrepreneur is really the only way, in my opinion, to create the best way to say is outsized wealth.
Mm.
You can work as a doctor, you can work as a lawyer, you can do very well. And I'm being a little bit narrow-minded in what I'm saying, because there are plenty of people that have created wealth in certain other professions. But outsized gains, enormous ones, are done by being an entrepreneur. And so when I saw the founders of WireImage do it, it was like, this is my time. I'd always been hustling, I'd always been doing different things, and I was finally ready to go out on my own. And that was when I founded a company called AudioMicro Inc., which had its biggest brand was known as AdRev. And so ultimately AdRev and AudioMicro Inc. were my ticket to doing it. And so there you go.
That's awesome. So, I think you and I were chatting a little bit before the show is, what are the things, because I think there's that whole entrepreneurship like seizure, I think is what they call it in the E-Myth, or, or the realization like, okay, yes, this is the way to make money, have freedom, all the different things that kind of align up for, someone willing to stomach the risk to jump in to becoming an entrepreneur. how did you know what you were going to be doing for your business? Did you have some inklings that you knew exactly what you're going to be doing? You just were waiting for the right opportunity, like the gains that you made from that acquisition that you went through, or like what lined you up, and then what exactly did you do?
Yeah, it's a good question. So when I was at WireImage, because it's important to kind of go back to that point in time. I was in my 20s. I was living in New York City. I was their accountant, and ultimately I was their financial controller and VP of finance. We had offices in like 12 different countries, and the thing that I was doing was, it was the photo industry. So we were aggregating and licensing still images, so just photos, if you think of it like that. Obviously, not non-video. Video wasn't as big back then. This is the early 2000s, and the industry of the photography industry was undergoing some changes, and I was following the industry very carefully. Like, I would listen to the conference calls of the public companies in the space. They were known as Getty Images, and Jupiter Media was a company at that time. They're no longer around, but actually Getty ended up swallowing them up. But anyway, so I was following like what they were talking about on their conference calls and following the industry. And I came across a bunch of startups in that space that were doing what's called microstock. And I was fascinated by microstock. I was like, this is the future of photography. And the difference between microstock and traditional licensing was that, so in first photos went through what was called rights managed licensing. Rights managed licensing means, hey, you're People Magazine, you want a photo. Then the photo agency says, well, where are you going to publish it? Oh, you're going to publish it in People. Okay, well, are you going to publish it on the cover, or are you going to publish it on the interior? Okay, are you going to publish it a quarter of a page, an eighth of a page, a whole full page spread? Okay, depending on how you want and how big's your circulation, et cetera, what countries you're going to run it in, depending on all your answers to all these questions, they'd be like, here's your price. So you said a quarter page, you said US circulation of 1 million, we say it's $400. Okay, so then they finally publish it. Then you find the image being published. Then you send them an invoice. Then 90 days later they pay you. I was like, this is crazy, right? I mean, this is like a lot of work to go
I was
through.
going to say, how would you? I can't even imagine that like quote sheet and how someone would actually come up with that $400.
Yeah, one of the most out of this world things, and now I'm on a sort of tangent here, but that we used to do is they used to sit there and go through all the magazines, the entertainment magazines, because and they would flag with little like post stickers all the images that were from WireImage, and then they would pass that flag magazine with like all these like little sticky things over to someone in the sales department to actually create an invoice, and then send it to the magazine to have them pay. And of course, then I was on the accounting side, and like 90 days later, they'd pay it, or you have to chase them down to pay it, whatever it was. And they pay by check, and you got to deposit the check. It was like totally bizarre. So anyway, this is all to go into the next thing that happened in licensing was called royalty-free imagery. And royalty-free imagery was like, you can pay, it started on CDs and discs, and you'd get this disc of like 1,000 photos, 500 photos. And anything on the disc you could just use as long as you bought the disc. Let's say the disc costs $1,000, you could use all the images on it over and over and over again. And then the next step was microstock, and microstock was sort of a offshoot of royalty-free licensing. And it meant the difference was it was crowdsourced. So instead of having, it also used to be, if you wanted to be a photographer, you'd have to send them slides of your work, and they'd sit there, an editor would review them, and they'd be like, okay, this photographer is good enough. We'll add him to our roster, and he or she's allowed to submit images. And, oh, this photographer is not good enough. And it was like, I was like, this is ridiculous. Like, crazy. So microstock solved all that. Like, anybody with a digital SLR, and now, iPhones have amazing cameras on them, and
Mm-hmm.
all cell phones do. But anyway, as cameras went digital, they went from film to digital, and the first DSLRs, one of the more popular ones was the Nikon D100. And when those came out, people around the world could just take photos in their home studio. You could be in Latvia, Croatia, Russia, you could be anywhere in the world and submit them to an agency, and they would just review them on the screen. And instead of like accepting or rejecting the photographer as a whole as a contributor, they could just pick and choose the individual images they wanted. So they were, in short, crowdsourcing massive amounts of photos. And they were licensing them for as little as $1. And in short, that was like microtransactions, like little small dollar licenses. And it was no longer, back to the People magazine example, like, are you going to use it on the cover? Are you going to use it on the interior? Fourth of a page, eighth of a page, half of a page, a whole page? Like all that stuff went away. And it was like, if this is in a magazine, it costs this one price. And it was crowdsourced imagery. It was simple. And the ones that emerged that I saw were called, there was iStock Photo, which Getty ended up also buying shortly after they bought WireImage. There was Shutterstock, which today is a public company. I believe it's valued north of $1 billion, possibly $1.5 billion. There was Fotolia, which ended up getting bought by Adobe for like $800 million. But at the time, I saw them when they were very, very nascent. And I said, I want to have one of those. That's the future of, we're doing celebrity photo licensing. Microstock's going to come into this space too. And that's what we should be doing. And so again, it's a long, long story of when WireImage got sold and I was like, it's time to go out on my own. I actually initially wanted to start a microstock celebrity photo agency. And believe it or not, that was the first vision for what ultimately became AudioMicro, which had really not much to do with celebrity photo licensing at all. You can kind of tell from the audio name. And then two, what ultimately spun out of that was AdRev, which had nothing to do with photo licensing. And the journey ended up, being a successful one. But I thought I knew what I wanted to do. I thought that celebrity microstock was going to be a hit and was going to let me retire on some private island. And the reality was that wasn't it. And we had to pivot a number of times. In fact, throughout the journey of AudioMicro Inc., which had an initial name of Image Collect Inc., which was the celebrity microstock that I wanted to start. There were like 6 or 7, I don't want to get the number wrong, different pivots of products and services that we launched, and which almost all of them died except for AdRev, which really took off. So, and then there was also, I guess I tell it in baseball terms. If I got up to bat, I had one company, but each of our products was a turn at bat. I probably got up to bat 7 times. I hit maybe 1 single. I got 1 walk. I got 5 strikeouts. And then on AdRev, I closed my eyes and I hit the ball as hard as I could. And it cleared the fence barely, and I pulled a hamstring running home, but I got there.
Right. Well, I think it's a really good. It's a good analogy, and I think the pivots is something that a lot of people don't necessarily talk about because it's like, oh, how did you do it? And then it's like, oh, I hit this grand slam. But the reality is, like, most times people are pivoting and constantly trying to figure out where they're going. And so I'm curious, like, as you were kind of going, a couple of things is like, did you self-fund the start? Maybe take these in order. Like, did you self-fund the startup? How did you actually structure it? Because as you were pivoting, I think how people have their company structure, how they're capitalized, impacts whether they're able to pivot or not. But then also, as you were pivoting, what was gravitating you towards certain things? Was it a need in the market, or was it a type of business model? Because obviously, the microstock business model was extremely appealing, and it kind of transferred itself into various other parts of it. So kind of walk us through the underlying workings of that, the pivots and the structure.
Sure. So the very early capitalization of the company was myself with no job. So I'm going to work on this full time. So with no paycheck. And if I fail, I'll go back to being an accountant. So I at least had like a plan B to fall back on. And the money that went into it was I had savings from the sale of WireImage. I cleared a little bit of, money in the sale of my stock. And I put a good amount of that into, I started, first employee, I was just paying them out of my pocket. I wasn't paying myself anything. And then I also got this was 2008-ish. And there were zero, like, credit was really loose. I think it still kind of is at this time. But anyway, like, you could get 0 interest credit cards with like $50,000 or maybe it was like $25,000 limits. And I got 2 of them. And it was like, oh, you don't have to pay this for a whole year. All you got to do is like make the minimum. And so I had like 2 0 interest credit cards that, like, I put a lot of the early bills, whether they be software development or hosting and storage. And I sort of was like, I'll figure this out later. And then, but I didn't want to like put myself into debt. So I quickly went out to raising capital. So when I landed, so after WireImage was sold, my wife and I moved from New York to Los Angeles, where she's from. And right as I got off kind of the airplane, I started going to networking events. And the first one I found was the Los Angeles Venture Association. It's known as LAVA, LAVA. I think it's like lava.org is their site. And I was like, okay, well, that's where the venture capitalists hang out at these events. So I'll go there. I'll show up and just start to network. So I started meeting venture capitalists. And this is a really funny story, and it's absolutely true, is as I got involved with Lava, just going to their events, getting to know the executive director, really great guy named Len Lonzi. As I got to know Len, he said, well, Ryan, you know how to use a camera. There's this whole other story I haven't told about me becoming a photographer on my nights and weekends. Even while I was the controller of WireImage, I also would spend my nights and weekends as a photographer. I taught myself how to use the DSLR. Anyway, so Len said, you know how to take pictures. We have our annual event. Would you be our photographer for the annual event? I'm like, sure, I'll be a photographer. No problem. I can handle that. So I was going around the room and I was talking to VCs and I'd be like, hey, can I get a picture of you guys together? And then after doing that to a couple of VCs, I said, oh, can I also tell you about my startup idea? And I literally pitched these two guys,
That's awesome.
David Kremen and Scott Lynette from a fund called DFJ Frontier. And they were like, I remember to this day, Scott says to me, he goes, yeah, we'll take a meeting. And I was like shocked. I was like, oh my gosh, this VC is going to take a meeting with me. And the funniest thing is after I sold the company, I was going through my photo archive and getting it all like organized and stuff like that. And I found the photo that I took.
Nice. Yes.
And I sent it to them and I go, this is when we met. And it was just like magic, it's just like that magic moment that turned into the company. So they funded me. After obviously they took a meeting and there was more meetings and more pitching and diligence, they ended up writing a $500,000 check into the company to capitalize it, and they were preferred shareholders. So they're traditional VCs, early stage venture capital firm out of Southern California. DFJ Frontier was the name of it. I think today the fund is called the Frontier Venture Capital Fund. They may have changed their name slightly, but anyway. So that was the first kind of money, and then
did they ended up what percentage?
Yeah.
So what percentage did they get of that? And
yeah.
how did you guys get the terms and conditions of what like that structure was going to be? What you're going to be getting for the 500?
So this is my first time raising VC. So they wrote me a term sheet, and if I recall correctly, the pre-money valuation on the business was $1 million.
Mm-hmm.
And so for $500,000, they essentially bought a third of it. Now I know that some people may think, hey, that's half of it, but you have to add $1 million plus 500 to get to 1.5, and then divide 500 by 1.5 to get to what they owned on what's called a post-money valuation basis. So anyway, that was the terms of it. And I was like, it wasn't great because these days, most startups for seed funding, you can kind of follow the market a little bit if you read a lot of the things like TechCrunch or whatnot. Like the pre-money valuations are like $5 million for a lot of these San Francisco and even LA-based startups. So they've come up 5 times since then. And had I raised on like a $5 million valuation when we sold, obviously it would have ended up being more for myself and our employees because we had an option plan and employees had stock in the company too. But anyway, I took it at $1 million. It was the term sheet I got. I didn't want to haggle with it. I wanted to get going. And it was like, that was kind of how, I talked to advisors, one of which is the founder of WireImage, and I got advice from him on kind of how to work a term sheet. And there were certain points that we went back and forth on, particularly liquidation preference and what they call participating versus non-participating, and what things like that. And I could go in a little more in depth if you want me to. So a few things were negotiated. It wasn't like I just took the term sheet and signed it, but the valuation, I just accepted that $1 million pre-money. And then throughout the rest of the company, they invested another $500K. So they ended up putting in a full $1 million because we burned through the first $500K, and I made what I would, looking back on, call a number of maybe mistakes with the money early on. Not like huge ones, but just things I just didn't need to spend it on. Or like, I hired a certain developer.
Learning mistakes.
Yeah, that didn't work out. Things like that. Yeah. So anyway, they ended up putting in another 500, so all in, they had put in $1 million, and then a strategic investor, actually Fotolia, that company I mentioned earlier, that was a microstock photo company, ended up putting in $200K. So all that we raised in the history of the company, beyond my initial investment of my time and some of my savings and the zero interest credit cards, was about $1.2 million of outside capital came into the company in its history.
So, and which is great context, Ryan, because I think one of the things that, I've interviewed other people on the podcast or, through stories is like, when you're pitching these people and nowadays, the biggest difference between a lot of traditional businesses and a lot of people that are VC backed is there's always usually like, what's your exit strategy? How am I going to get my money back? So that's the biggest difference I've seen with people that don't have that. They kind of just chug along until they realize, oh crap, I need to sell, versus usually it's push forward and you pivoted a bunch with, as you're using other people's money and you've got partners that have invested in this. How did those dynamics work? I mean, as you were pivoting and you were doing these different things, what was their input, and was there an eventual exit strategy in your pitch to begin with?
To begin with, yeah, I think I had it's all a story, right? Of what you think is going to happen in the future. It's all the fancy word people use these days is a narrative. But I believed, and mine was definitely sound, but it was, there are these players in the space that are acquisitive. There's Getty Images. There are these other microstocks today. Shutterstock is big enough to do acquisitions, and they have done some. And so I think my initial pitch deck had us selling, after we grew to sizable business in terms of revenue and EBITDA, us selling to one of the larger players in the space. So it was an industry that existed, licensing of content. In the case of my initial business plan, it became a microstock music company was what I was pitching. Basically, if iStock Photo was selling photos, AudioMicro was licensing music. So as people would be creating video on their phones, people would creating more video, period. They would need music to accompany that video, and they would turn to AudioMicro as the place where they would be licensing that music from, and it would do millions and millions of dollars in revenue, which it didn't. I had to pivot. It was much smaller than I thought. But there was an exit kind of part of my pitch deck, my VC pitch deck, unquestionably. But that was in years. Everybody's pitch deck, right? Yeah, I've seen a ton of them myself now. And they're all like, okay, we're starting at nothing, but in year one, we're going to do, $500,000 in revenue. In year two, we're going to do like 2. And then beyond years 2, they come up with these like crazy numbers. And by year 5 and 6, it's like
Unicorn.
$1 million in revenue and $8 million in EBITDA. And you're going like, do you know how many companies on the NASDAQ even do 8 million in EBITDA on 50 million in revenue? It's like very few, but like, anyway, so I always have this joke about like anything beyond like 1 year or is just a joke. Like, don't even look at it. But at least people should put reasonable numbers in there, because if they put unreasonable ones, I immediately am like, I can't invest. Like, this is just it's too far made up to be reality. And I like to be with people that are more on a realistic wavelength. So anyway, yeah, but I probably had numbers like that somewhere in mind, but they were probably a little bit toned down from the average entrepreneur.
Well, and I think it's interesting that, with your exposure to that acquisition, did you understand going in the EBITDA, the valuation, the financial benchmarks that you were marching towards? Because so many people don't even think about that stuff. And so, what's also being a CPA. So were there the financial benchmarks going in? Did you have kind of like, so you had this, exit strategy, but the valuation in mind as well? And how did you measure that kind of stuff? Does that make sense?
Yeah, I think I understand it. Here's what I'd say. The accountant in me says that a company that doesn't make any money isn't worth anything. That's the accountant in me. But I learned a very valuable lesson at WireImage, which was that's not true. And the company's worth what someone will pay for it, regardless of what its actual EBITDA is. If it's got EBITDA, it's a lot easier to start to put some multiple on it, and come up with like, even if you just do like a discounted cash flow
Yep.
of some sort, you can come up with something that somebody would pay today in order to receive, what this thing's likely to generate in the future. But and so the economy was like, things that don't make money are worth nothing. But what I realized at WireImage is that that's not true, because by nature of a company that needs capital, that needs cash, whether it be through even an IPO or a startup that just needs cash to get going, by nature, it's going to burn that cash. That's why it needs it, you know? So it's not going to be very unlikely to be making any money while it's burning that cash, unless, for example, that cash is put into like what they call PP&E, or property, plant, and equipment. Like maybe in your case of you and your dad's business, it was like purchasing copiers, for instance. If you needed to buy 12 copiers to start the cash flowing, you might need the money to put towards that. And those assets would be potentially collateral for, if you had raised it as debt, they might be collateral for debt. But anyway.
And buildings or whatever a lot of
Yep.
small businesses do and stuff. Yep.
Totally. Real estate. Exactly. But I realized that wasn't true, because WireImage, we were growing really well. We were growing the revenue at that company. It was growing very well, but it was burning a bunch of money. And as the financial controller and VP of finance of the company, I was like, man, we're in for, if we don't raise more cash, we're going to run out, and we're going to, be in a very bad place. And who's going to buy this thing that doesn't make money? Well, I realized that Getty came in and bought it for a ton of money. I think it was like 200 mil. I realized they wanted it, regardless of whether it made money. They wanted it because it had dominant market share in entertainment photography. And they didn't want to be number 2 in any market of photo licensing. They wanted to be number 1, and they needed to take out their number 1 competitor, regardless of what its EBITDA was. And for them to put together a deal at that price was totally doable. They were big; they could do it. And maybe after they bought it, they would figure out, economies of scale, and which things on the burn side don't need to be there. For instance, we can consolidate all these employees. You don't need your office, so there goes the big rent in Manhattan. We can take half your sales staff and integrate them into ours, and the other half for maybe they didn't need. I'm not saying that's exactly what happened, but like they can come. Your accounting department, which I was a part of. Well, we can just assimilate that into ours. It's just more, spreadsheets to do, and our team has a little bit of bandwidth to do it. And so, in short, I wanted to build a company, though, that was making money, because another thing, sort of anecdote I try to live by, if you will, or I've told myself, is get to break even as fast as possible. And the reason you want to do that is because then you're not beholden to investors. You don't have to have outside capital. You can, if you can still raise it, if you've shown that you can build a business, but you don't have to. You're not going to go out of business if you don't have it. And you can, at that point, decide, like, the world is your oyster. You can keep operating it and growing at a certain pace, or you can raise more capital. If you can deploy that and grow faster, you can. But at least you're not going under without having more money. And so try to sprint. I sprinted as fast as I could towards break even once I had the kind of runway to go up, which was the growth of AdRev was able to get us to break even, and then some. Ultimately, we were generating significant amount of EBITDA.
So were your pivots, Ryan, associated with, like, and kind of walk through, which, by the way, all that context is huge, with understanding your strategies on the business and where you're sprinting towards. So was the pivots because you were listening to the market and understanding how, what you needed to actually deliver? And then what were the strategic mechanisms you were putting in place to sprint to break even? And did that sprint have to do with your pivots?
A bit of it, yeah. Yes and no. So, but I know where your question's hitting on, and I can address it. So here goes. So AudioMicro. So it started as Image Collect. I wanted to do microstock celebrity photo licensing, sort of what WireImage was doing, but just crowdsourcing it and licensing it more by subscription and for small dollars than through the rights managed process of flagging the magazines, like I described.
Mm-hmm.
And the first thing you need to build a content library, whether it be photos, whether it be music, whether it be video, is you need content. And then the second thing you need is you need buyers. You need people to license that stuff. And it's a little bit of a chicken and the egg situation where if you don't have buyers, who's going to want to give you their content and put it
Mm.
up on your site? Like if you
Yep.
have no traffic and you have nobody's ever bought a photo from you, why would a photographer want to put the photo with you? So you could say, oh, we really need some customers first in order to get the libraries, but the real reality is you need some content. So you've got to get content. So I was trying to get celebrity photo archives together from photographers that I had gotten to know that weren't WireImage and Getty photographers. When I was doing nights and weekends of shooting, I would stand next to a lot of guys and gals on the photo line, and I'd be like, "What agency do you work for? Are you independent? Do you actually own your images, or does your agency own your images?" So I quickly figured out who owned what, and then started trying to get archives together to put on Image Collect. But this was 2007 and 8, and the economy hadn't fully collapsed, and these photographers didn't want to put their images with me. I didn't have any buyers, and they knew that. But two, they were like, well, still used to getting $200 or $400 or $100 a picture from a magazine. And if you're going to price it by subscription for, like, let's say $100 a month for 25 images, so that's like $4 a pop, that's way too low. You're going to drag the market into the gutter. And I want to, I'm still happy with my current situation. So I try to get archives, meaning libraries of images from like the last 10, 20, 30 years, as well as current images from new events that were happening every day. And I couldn't. So I went with my plan B, which was I'll do microstock music. The music industry looks a lot like the photo industry did 10 years ago. When they do licensing into a video, a film, or a television show, they're doing rights managed. They're saying, where's your film going? Where's your TV program being syndicated? Is the music the theme song? Is the music, all these different questions before you come up with a price. And I was like, that's crazy. You got to have a microstock outlet. So AudioMicro was really like my plan B. And I realized after getting a music library together and sound effect library together and getting some buyers that market was a lot smaller. They call it the sync licensing market without going into too much detail on what synchronization licensing is. In short, it's the attachment of music to a moving image. You're synchronizing it with image. So for instance, use in a video is much more simple of any sort, whether that be TV, film, or web video. And that market was a lot smaller. Just the sync licensing market was a lot smaller than what I thought. And for instance, the photo market's like of still imagery used to be around a $2 billion a year market of total annual revenue. Not huge, but not paltry. I thought music licensing was going to be bigger than that, and sync licensing would be that big, but it's not. It's somewhere, depending on whose estimates you use nowadays, it's pegged at like 300 million, maybe growing to 500 to 600 million. So it is a growing area, but it's just not as big. And so AudioMicro, as a library where people went to do micro stock licensing of music for videos, it was a single. Again, back to the baseball analogy, it wasn't a home run. It was a living business. I had revenue. I had customers. I was able to, we had gross margin. We had gross profit, I should say, on that revenue. And after we paid our software developers and our employees, there was some left over, but it wasn't big. It was just a single, and I couldn't see it scaling bigger and bigger. And so we tried a number of other things. So here's what we tried. The next thing we tried was around 2000. There's actually like a video out there somewhere of me pitching this, and one of the judges, funny enough, is like a guy named Chris Sacco, who's like a really big investor these days. But he judged my little pitch at the launch conference, and basically we pivoted into a bunch of different other marketplaces. So we had a microstock music marketplace of AudioMicro. We took that technology, that whole back end of crowdsourcing content and an e-commerce storefront, and we did cartoons. So we would aggregate cartoons from cartoon artists, and the idea was to license them to editorial publications like New York Times or somebody that would want to run a cartoon, or even a local paper too. We did tattoos. So the idea was to aggregate tattoo art and then license it to people that want to get a tattoo. They could buy the full-on color artwork from our site. It was called Choose Tattoos. And they would also get a stencil along with that artwork.
No way.
And then they would take that artwork to like their local parlor and say, this is the dragon I want you to put on my arm or whatever. And their artist could then use the stencil as the outline and use the color one as inspiration for the, basically getting the right dragon. Because if you're going to put something on your body, why not have it mocked up once or twice, right? Or try it,
It's the
print it
ideal
out,
situation.
hold it in front of your arm in the mirror and flex a little bit. And do you really want that dragon? So that was the idea. We did infographics, so we would crowdsource infographics, and then we'd also finally I was able to do image collect. So imagecollect.com actually did finally launch, subsequent though to AudioMicro launching, and we had already renamed the company as AudioMicro Inc. at the time. So all of them failed. So except for Image Collect and AudioMicro. So Choose Tattoos, I sold a few tattoos, but not enough. I realized it wasn't happening. Stop investing in that. Cartoonsy, which was a cartoon marketplace, I think we sold one cartoon. I was like, that's not working. Infographic Stock, which is the infographic marketplace, we didn't sell a single infographic, license a single infographic. So I was like, that's not working. So finally, though, AdRev so we launched all those marketplaces, which was one of our pivots. Again, all of them failed except for Image Collected. That was more of a walk. Like it did okay. It got some revenue. It had some margin. It was an existing business as well as AudioMicro.com. We had ImageCollect.com going for celebrity photos, and it was alive, but not huge. And I was like, well, what's happening next? And almost around the same time as those businesses launched with the whole big tech conference, it's called the Launch Conference. Well, I'm also leaving out a whole pivot in between. So prior to all that, I'm sorry, I feel like I'm telling.
No, I want to know. I think it's important, Ron, because I think so many people don't realize that you're having to pivot because, well, first of all, you're trying to make money. You're trying to also scale and not just have a hobby business, all within mind that you've got investors and need to liquidate. So I think it's a tough mental gymnastics that a lot of people don't necessarily realize, or talk about the fact that they got to keep all those in balance.
Totally. So I'm going to take one set. So I'll real quick, I'll finish what I was saying. Was almost around that same time AdRev was born. But before I go into the story of AdRev being born, I wanted to go into one previous pivot that I didn't even mention, which was as I saw AudioMicro sort of not scaling to be as big as it needed to be to get a liquidation for the investors, just like you said. I thought that there was a time on the internet, and you may remember this, where everybody was publicly sharing everything they did. And they still almost are. Probably, I shouldn't even be like there was a time, but there was a time when it got ridiculous.
The same, right?
And it was, Twitter came out and people were taking pictures. Here's my lunch today. I'm eating,
I'm going to the bathroom.
Noodles. Yeah, now I'm going to the bathroom. Like seriously, they were telling you everything they were doing, and I was like, I wasn't the kind of person that really wanted to do that for myself, but I was like, if people are doing it, like I'm missing something. This must be the future. So I saw this startup emerge, and this startup was the public sharing of your credit card transactions. Actually, not very
gosh, I don't remember that.
Yeah, this one was called Blippy, and it raised like, I don't know, $10 or $15 million. And when I saw the headline, I was like, that's where I need to be, publicly sharing of something. And the funny thing is, Blippy, we joke about it a little bit, if you will, was not that much unlike what Venmo is today, where like you can, if you have it set to public,
you're right. Yeah, no kidding. Yeah,
you're like, look, my friend just paid for his dog walker.
Bachelor party. Yeah,
how cool is that? Yeah, paying you back for the bachelor party, bro. So cool. It's publicly sharing of your life. Well, there's this Blippy was public sharing your credit card. Like every time you'd swipe it, it would like say, Ryan bought soap at CVS Pharmacy. Who wants to watch that? But if that's what's happening, so I decided, in a dumb way, I'm laughing about it, I was like, voicemails. We're going to do public sharing of voicemails. There's got to be a bunch of funny voicemails out there. And so we had this platform called Audio. It was spelled audio with an extra O, so AUDIOO.com. It might even still be up. I don't know. Probably has been taken down. But anyway, where you could like extract voicemails from your phone and post them there. We had various methods of you publishing your voicemail to us, and the idea was people would vote on them. And we did this whole launch at TechCrunch Disrupt, and I was on stage, and we had Johnny Brennan from the Jerky Boys there, who's an awesome dude, and he was like, it was all hype, like trying to like get people to publicly share their voicemails, but no one wanted to do it. The only revenue I was able to earn, and what was the revenue idea there? Like nothing. I thought maybe we'd have advertising on the site. We would just make money off of like Google AdSense or whatever. But the only revenue I was able to generate was I did get one like phone related software company to like buy some display ads on Audio. But anyway, beyond that small little check I got from them, it was like, this is a failure. So I shut that thing down. And
What are your investors saying as this is happening? I mean, like,
yeah, it's funny, here's what I'd say. So the lead investor from DFJ, the guy whose photo I took at that lava event, was ended up being a guy named Scott Lynette. And it's to this day we're still buddies, and he is so encouraging and so positive. It is mind-blowing to me, because I'm like, I'll kind of crap on an idea if somebody tells me something. Like I'm kind of a first person to sometimes shut things down. And Scott's just like always really positive. You'd just be like, go for it, try it, go for it. And he was just always like on the sideline rooting for us. And he was just always so positive. He was never the opposite, and he would never shut things down. And so, the answer to your question is, he was shockingly supportive of everything we ever did. He just let us do our thing. I mean, he was just a good person about it. And I don't know that I've seen it, but I've heard about it. I've heard of toxic investors. I've never experienced one. In fact, and even in my new company, HAAWK, like our lead investor, his name's Jim Andelman, and he said to me something like, my motto as an investor is a little bit like the Hippocratic Oath, which is do no harm. Do not harm the patient, treat the patient, help the patient, be helpful. And so I haven't experienced that, but I have, anecdotally had people tell me stories of like, oh my gosh, you won't believe what this guy who put in 50K is trying to do to our thing. And it's just like, I don't know what to say, but the best is, you have to pick and choose your investors really wisely. And I think in I was just lucky, I mean, Scott is a gem, and I was lucky to find him,
yeah, nope.
Same as Jim.
So as you're pivoting and stuff like this, as you're going through, like, you're where you're still having your eye on the bottom line, and as you're pivoting and stuff like that, was there a timeline or evaluation or a specific person as a buyer that you were targeting that was making this all, like, to give you the motivation to wake up and keep taking the punches?
Later on there was. So once we hit on AdRev, and I can get into what that actually did, because it is a little bit different than the other ones. I was just the marketplace businesses. I started to realize that there were players in the space that would want to acquire that type of business, or did do that type of business, which that business is sort of an offshoot of content licensing, and it's called rights management. And essentially what we were doing at AdRev, and I could get in, if you want to hear it, let me know, but the story of how it sort of happened. But what we were doing was we were fingerprinting music and finding YouTube videos that use that music without a license, the ones that didn't pay for it and properly get a synchronization license to use it in their video. And there were millions of these videos that were using music without a license. And we would get those rights holders paid, whether they be the owner of the master recording, which is typically known as a label, or the owner of the underlying composition, which is typically known as a publisher. Didn't matter. Whoever owned either the master or the publishing was a potential client for us. If they owned both, even better. And we ended up specializing in a type of music really known as film and TV and trailer music, which is typically actually owned by both sides. The master and the publishing are typically owned by the same party, known as a production music library. But anyway, and so that's really what took off. And then within AdRev, we grew a full service division for large production music libraries, where we would handhold and give them very white glove service. We built a self-service division where people could upload on their own. Independent artists could upload and contribute their musical works to us for administration on YouTube. And then we built an MCN, which is a multi-channel network, which was a very hot term. It's now kind of looked down upon, but we built our own MCN, which was an aggregation of YouTube channels, and we would help them grow their own channels and provide them with different benefits for signing with us, and the revenue would pass through us, and we would keep a percentage of it. And we ultimately grew. Once our EBITDA was kind of going nice and steady, we were able to acquire a music distribution company called Dashco. Music distribution is the concept of taking musical works, recorded music, and, if you will, an album, and putting that album with iTunes, with Amazon Music, with Spotify, with Deezer, with Google Play Music, with all the various streaming services. So we ended up buying a distribution company, and then collectively that made up all. AudioMicro Inc. had AdRev with the full service, self-service, and the MCN. It had Dashco through the acquisition with the music distribution. It had AudioMicro.com, which was the sync licensing, microstock synchronization licensing, and it had Image Collect, which was the microstock celebrity photo licensing. And that whole entity was what ended up getting acquired. And I sought out, we didn't use a banker. I sought out a number of potential acquirers in the rights management, licensing, and distribution space, primarily music. Image Collect was a very small piece, so that photo licensing business wasn't too much to speak about. So the rest of it was around music licensing, distribution, administration, and was able to, at the end of it all, make a deal happen, and it was a very kind of fruitful deal for everybody.
So what was the triggering event that led you to seek out, and why did you not hire an investment banker? And then, we'll start with those two questions.
Yeah, so we, as we were growing, we started to, make these lists, let's say, of fastest, the most notable ones, the Inc. 500. So Inc. 500 lists the top 500 fastest growing private companies in the United States every year. At least it's the fastest growing ones that applied, because not every company even wants to apply. But we made it in, the 2013 list, which was related to our growth through 2012. So for the 3 years ending with the end of 2012, we made it in the 2014 list, and we made it in the 2015 list. And I'm going, man, like, are we going to be able to hit this Inc. 500 list like every year? Like, this is it's impossible. You can't keep growing that fast, like in the thousands of percentages over 3-year periods. You can't do that forever. And I remember, like, I used to blog, and my website's ryanborn.net. And at one point I'd written a blog about Dig. I don't know if you remember the company Dig with 2 G's. Do you remember that one?
Yep.
So the story, it was a story of Dig, and it was like basically how Dig had at one point gotten offered $1 billion. I think.
Oh my God, I know. It's a stomach ache, right?
Totally. And maybe I'm wrong on who it was, but I think it might have been Yahoo or somebody, like, reportedly offered them $1 billion, and they turned it down. And like a year later, Dig was worthless, worth zero. And maybe I'm exaggerating. I don't know if they sold for like, 50 million or something, and it still wasn't that horrible. But it went from $1 billion to basically nothing. And I just remember that in my blog post is titled something like "Hop Off the Train at the Right Time." And it was basically like, things don't last forever. And, we've seen this happen, whether it be, economies and things going through economic cycles, like growth and they just, they just don't happen forever. And we're in this weird period right now where we came off of the recession of 07, 08, and now we're, it's halfway through 2018, and things are have fully recovered beyond belief, and the stock market's up wildly, and real estate market's up really amazingly, especially particularly, at least in Los Angeles it is. And it's like, I'm just thinking, even as we're talking, I'm like, this isn't gonna last forever.
Where's the hammer?
Like, it's coming. It's coming. Like, is it coming tomorrow? I hope not. But it's coming. It's coming. And so my thought process after I had these great growth years, like 3 years in a row, I go through that kind of Inc. 500 thing. I'm like, this can't go forever. Like, you built something that's valuable. Like, get out of it while you can before your growth slows. And also, obviously, I knew internally, just like almost like finger in the wind kind of feeling. It's probably a little more scientific than that, but basically, am I signing as many deals as I used to sign? Like, for a 3 or 4 year period, I was signing all kinds of rights holders to AdRev. Like, lots and lots of clients were pouring in. But then slowly it was like, okay, instead of like a deal a day, it was like a deal every other day. And then it was like a deal every week. And then it was like a deal every other week. And I'm going like, okay, like, I can feel that this isn't, we've got to come up with another new revenue stream, or another new revenue line, or another new product and service, or we're not going to grow as fast. And so it might be wise to start looking for buyers. So why we didn't use a bank is probably varied reason. I'm pretty scrappy, and I always never really could stomach the idea of putting a deposit with an investment bank. Like, okay, if you guys can go out and find a buyer and close a deal, like, I get that you could earn a commission. They typically command a pretty high commission. I've never actually hired one, but I think it's like 5%.
It's like 3 to 10% depending on size of the deal and everything. It's yeah.
Got it. Yeah. So I'm thinking, why do I want to give them? Why do they get 3 to 10% or 5, whatever the number was, like, of a deal? Like, that's crazy. They didn't work at the company. They're just sort of brokering this final transaction, and so I don't want to, I don't want to give that up, and I don't want to put a deposit with them where if they don't succeed, they still get to keep the deposit. I get why they want one. They don't want to do work and not make anything, but I just didn't really think it was fair. And so I was like, I know who the buyers are. Like, let me try to do it on my own. And I went at it on my own. And like, there's, part of me thinks maybe it would have been a smart idea to run a formal process with a bank where they, have the whole book and they shop it and they sort of do the, hey, they only want to, they can kind of play hardball with people and get the run the price up or whatever their game is. But like, I just didn't do that and went at it on my own. And it was a ton of work. I mean, I was like running around like crazy, still trying to grow the business, answering client phone calls, simultaneously trying to sell the business, flying around, trying to meet these prospective buyers and work through the due diligence process and all this stuff while the troops were back at home keeping the fort down. But it was like, it was kind of wild, but it ended up okay. It ended up just fine. And I actually think looking back on it at the time, we got a great deal, and it was, I wouldn't take it away. I mean, it was a
What was
good
the
deal
size of
for.
I mean, if you got some top line gross numbers or employee count or something, what was some of the benchmarks of how big the company was?
Yeah, it was generating well over multiple double digits of top line revenue. Sorry, multiple double digit millions.
Yep,
Probably the
yep.
best way to say it. So that would
$10.
be 7, 8. That would be 8 figures, multiple 8 figures of top line revenue, and it was generating multiple 7 figures of EBITDA. So you can. I don't want to give
Well,
its
yeah, you can kind of back
numbers
into it.
away, but
So
you can kind of guess where it was, and so it was a decent company, and employee wise, it was actually fairly leanly run. The headcount,
leading to good EBITDA, obviously. And
yeah.
what was the? No, I think when you and I were talking, some of our mistakes were it's the deal structure. So let's say so you chose not to go with an investment banker, which their role varies depending on who you hire or choose to hire with the process, and their goal is to drive up the price. But like for the deal structure, you know, in what kind of role did your investors have, or how did you help structure the deal and the terms and conditions? I think there's such a huge amount of gotchas out there because it's like, hey, by the way, here's your multiple millions of dollars, but then, oh, by the way, and there's all of this other stuff from your involvement, what's going to happen when you get the money, the taxes, all that kind of stuff that are involved in it. Did you go in eyes wide open? Did you have people that helped you, and how did you kind of work through that?
Yeah. So Scott was definitely extremely helpful as, he was a large shareholder. His fund was a large shareholder in my company, but he was very helpful in terms of like advising. Like, I would turn to him a lot for all the questions and what were coming through. He took a meeting or two with each potential acquirer. It starts with, you go out, you try to find a potential acquirer. You end up, once you get one LOI, which is letter of intent, and it says, here's a letter, we basically want to buy the business for this much money. Here are the other terms and conditions upon which we would want to buy it. It's usually a couple pages long, non-binding, except for once you sign it, you usually enter an exclusive negotiation period for a particular period of time. Maybe it's 30 days, 60 days, 90 days, something like that. And once you get one of those, you haven't signed it, but you've gotten one, you can then go to the other ones you're talking to and you can go, well, I got my first LOI. Do you guys want to throw one in or not? And you kind of got to like push people towards doing that, because they're going to kick the tires as much as they can. And if they don't think that there's competition on the deal, they're not going to necessarily just write you an LOI. And the price on their LOI is going to usually be their first offer is going to be low, right?
Mm-hmm.
So we got like a crazy low one that I was never going to take, but it was an LOI. And obviously I thanked them for sending it and making an offer. It's better than not making one. And then I went to the other parties and I was like, we got an LOI, like, you guys want to put yours in? And then they put theirs in. And then the third one maybe puts its in, and you try to drive them up to, a more reasonable price. And we actually had one that we entered into exclusive negotiations with, and they were kind of slow to close. Like, we were going to go with that deal, and they were like dragging their feet on like certain legal terms in the long form agreements that were, if I recall correctly, it was something silly. It was like related to like indemnification baskets, which I don't even want to bore your listeners with what those are, but like, you can let the lawyers figure them out. And it basically means if there's like a claim that comes in, who takes the hit for it first? Is it the buyer or the seller, and up to how much, and that kind of thing. And it's like they were like dragging their feet, and the exclusivity expired because the deal hadn't been closed by that point in time. And so at that point, I notified them. I said, our exclusivity period is expired. I'm in good faith want to negotiate with you to close this transaction, but just so you know, at this point, we are free to entertain other potential suitors. And we did. And ultimately another one came in, and they wanted to pay much more. And I went back to the one who we'd almost closed with and said, look, we got this much higher offer. Do you guys want to match it? Like, we'll still close with you if you guys want to match it. And they were like, they were like, no, we'll come up they came up the tiniest amount. It wasn't anywhere close to matching. And they're kind of were like saying to me, well, we don't think that deal will actually close. Like, we close. We have money and we close. We're closers. When we want to do a deal, we're going to do the deal. And this other one, even though you got it, we don't really think it'll close. And if you go with that one, just know that we will not be here when you come back to us, kind of thing. Right? It's like poker, right?
Mm-hmm, mm-hmm.
And I had to have this thought. I was like, should I take bird in hand? These guys are going to close. They're telling me how they close everything. They got all this cash, and it was true. If you went up their capital chain, they were private equity owned, and they had a lot of money. Or do you want to go with this other party and who they think may not close? And it was like, I'll roll the dice with this one. It's just a better price. And of course, that other suitor actually did close, and it was reported at $20 million cash for a majority of the business. And, reality was it was a little more than that, but that's, that was a good deal. 1.2 million in outside capital raised for an exit well north of 20 million. And it was a cash deal.
So a couple questions on that I think there's a lot of people that I've talked to, people who've been on the show, that they just go with one buyer, which obviously you specifically found the reason why you don't do that. But then, you had talked about, you did a couple things that I see as extremely right, which is a lot, but also the fact that you had mentioned that, you don't need to be making money to sell, because there's a lot of strategic reasons people will buy a company that's not making money, which business valuations and how they're valuing a company like that is up to them and what it's worth to them. But then there's a typical financial way, which is a multiple of EBITDA or discounted cash flow. How were you strategically doing that, Ryan? Because you were strategically going to a strategic buyer because you said you knew the buyers. How did they value it, and how did you know what cards you were playing when you were looking for that number?
Yeah, so I just on the EBITDA, because we had solid EBITDA, had a decent number on what's like kind of what I think we're worth on that basis. But then Scott, who does a lot of investments, he knew what companies in the YouTube space were going for, because he had either been in other deals, or his partners and his fund were in other deals that were in the space, and or his colleagues. And they all talk, right? They all know each other.
Yep.
VCs know each other. They compete against each other, and they serve on boards with each other. I mean, they know each other. And so he knew, maybe from his colleagues as well, what multiples other companies in their portfolios were selling for. And so he actually, I remember being in the meeting with the first suitor that had the very, very, very low offer. It was like the first LOI, and him saying back to them, well, I know, companies in this space typically go for this multiple, and it was way higher, and I'm like looking over at Scott going like, is he bluffing, or is he playing? And like, we left the meeting, and I'm like, who are you referring to? Like, and he's like, dude, I know for sure, like, this one sold at this multiple, and like, you can get that much, it's possible. So don't take this deal at that price. And so he was very helpful in knowing it's these are private transactions, so it's not like you can publicly know how much AT&T bought Time Warner
Right.
for,
Right.
right? Like that's maybe pegged in public because it's so big, and they have to disclose it because it's so material. These kinds of things, when they're $20 million deals, $50 million, even $100 million deals, if they're not material to the acquirer, they don't get pushed out. And so the only people that really know the terms are somebody that might have been
Involved or the owner.
involved,
Yeah.
right? Yeah. So he was right. The truth is he was right. The number that he thought we could get was the number we, maybe even actually a little bit better, we actually did get. And we would have taken less than that, because that was the best I had at the time. But through this sort of, you know, different LOIs, different suitor situation, the exclusivity expiring and somebody coming up on their offer, we ended up with the right number. We ended up at what would be considered market, or maybe a little bit better than market price for our company at that time, and it worked out.
And was it a multiple of EBITDA or multiple of revenue? And then how did that affect like the strategic? I mean, maybe it was just a different way of actually getting to that value where it was a higher multiple because there was a strategic reason for them to do it. Because I think in the context of my question is there's you know what I usually tell a lot of our clients or people I've heard from is that a buy, like you said, a buyer, your company's worth what someone's willing to pay for it. So the strategic situation, the multiples kind of go through the roof or they go out the window because there's a strategic reason. So was there kind of two different ways that you got to that dollar amount?
Well, they put forth that number, right? Like, we didn't say it needs to be this number or we're not doing it, kind of thing, which is
Got it. You let the market.
honestly not a bad strategy. If you ask me, looking back on things, if
I
you just
agree.
tell the seller, this is our number and we'll do the deal at this number, and you're comfortable with that, they may come up to it and you're good. You don't have to play this sort of silly game of back and forth,
Or
Uh,
they say yes and you left a shitload of money on the table.
Yeah, well, that's the other way to look at it. But as long as you're comfortable, it's true. Make a good point. You kind of consider yourself. There's always this. He who throws out the first number always loses, right? That's kind of like a business. Call it a whatever. Business isms from Ryan. Like that's one of those things I've said is like he throws out the first number always loses. But because like you said, if you throw it out and it's what you want and they take it, maybe you could have had higher, so you're losing. And if you throw it out and they're like, no way we're coming up that high, we're walking from this, peace, see you later, then you lose a potential deal. you
Hmm.
know so it's like it's always tricky. So I tend not to like to throw out the first number. I prefer for somebody else to. But anyway, in this whole situation, we had numbers going back and forth with other suitors, and this other one came in and they threw it out, and it was a number we were totally willing to take at that point. And it felt, back to kind of what Scott had like kind of guided us towards. Like it felt like it was above, a little bit above market
Hmm.
price. Yeah.
Ryan, as you're going through all this, because you were running the company, keeping it afloat, and flying all over, meeting with these buyers, and doing all this stuff, did you have any inkling of what you were going to do afterwards, or what your role was going to be in the business afterwards, and whether you want to control or to walk away? And how did that whole journey, like once you signed, how did that all transpire?
Yeah, so I had high hopes for the acquirer. I believed that they were going to execute a roll up, beginning with my company, that they would begin to acquire other companies that all had synergies, that were all in what I believed would be in the music distribution, administration, and content licensing space. You could even say content distribution, administration, license. It didn't have to be music because I have, the photo background and video background too. So I thought that that's what they would be doing, and that I could play a very important role in their executive team, and that there would be equity for me going forward, so that I would be motivated to do a great job and stay on. That didn't turn out to be the reality after the deal closed. It turned out to me like the deal closed, we got paid, we made it through the earnout, and everybody got their payments, and I was like just an employee now. And I could come into work and I could make my base salary, which I had just been paid a significant amount of money, and the base salary really wasn't meaningful anymore, at the number that I was being paid. And they weren't going to pay me lots more at a base salary. And I went from an owner to an employee, and it was like just totally weird for me. It didn't, I didn't feel motivated. I didn't need the base salary. And so why was I going to bust my butt anymore after I was comfortable in terms of, what I had just cleared, through capital gains? It was like, why, what else is there in life? I had put aside my social life. I'd put aside a lot of my family life and responsibilities. I had a young child and wife, and I needed to kind of just get my life back in order. I was out of shape, and my back was starting to hurt, and all that's been corrected. I'm now, my back's feeling great, and I've been, playing lots of sports and exercising a ton, and everything's, good in that regard. But at the time, it was like I felt burned out, and just to work for a base salary, I resigned, and
How
luckily
did
I
that
left
feel?
it was sad. I didn't want to do it, but they didn't give me any reason to stay, you know? And frankly, it was depressing, like not just resigning, but like the year plus after was like, I went from, having started something that through twists and turns and almost going out of business succeeded, and got this good exit. And, I felt like I had the golden touch, and, everything was great. I'm important. I'm CEO of a startup, and, venture backed startup with an exit. And then I went from that to like sitting on the, I'd go work out, I'd get my smoothie, and it would be like 10:30 in the morning. And I'm like looking at the stock market going up and down. And I'm like, no, the phone's not ringing and nothing's blowing up in my email. And I'm like, oh man. And it really, as a happy as a time as a lot of people would think it would be, they're like, got paid, like go party, like whatever. It wasn't, because one, I'm too old to go out and party, and none of my friends want to party on Tuesday. They all got to work,
Right.
and I might not have to work, but they do. So there's no one to celebrate with. And my kid's in school all day long. And so I can only see her when she's back from school, which is pretty much at the end of the workday. Kids go to school for a long time. They're there like 8 in the morning until like 4. It's a long time, And so it was like kind of like what's going on? Like I was sitting there watching the stock market, the doorbell would ring, it would be like Amazon.com with a package, and I'm like great. Like I just
So true.
opened the door, and then like next thing I know, it's like, what are we doing for dinner? Can you make a grocery run? And I'm going like, how did all this stuff just happen when I was working before? But all of a sudden, like I have to answer the door, I got to clean up my mess, like whatever. Like it sounds so silly, but like basically, it wasn't rosy. It just didn't feel rosy. I felt like I needed to be active. I needed to be involved. And so ultimately, first we started doing some consulting for animation studio in LA, and that got me kind of back into working. And then ultimately, I was like, being, consulting, while it pays, it just isn't exciting, because you're not the owner, and you bring them all these ideas, and if they don't want to execute them, it's just sort of like, that's it. Those ideas die. And so I decided, along with my co-founder, Ben, to start a new company called HAAWK. And part of it was just like, I just got to get active again. I just can't, I'm too young to just sit on the couch and flip the channels and answer the door, So
I
we
do.
ended up with a new company.
It's like so funny, Ryan. Like, I mean, even to this day, I know my dad's going to listen to this, and a lot of people can relate that have gone through this, what you've gone through. Like, okay, him and I, as business partners, would talk literally all day, every day. And then it's about business because there's a reason to talk. And now it's like, we're still trying, but it's like, I know you've got Comcast showing up and there's an HVAC and you're fixing this, but I'm like, you remember you never used to talk about that stuff, and it just used to happen. And like, there's just this whole void there that it's tough to explain.
Absolutely. It really is. So I
So
missed it, and I
So,
had to
so
get
how
back
did
in.
you, so with like with Hawk Consulting and what you're doing now, I mean, what's the goal? How did you, what are you guys trying to accomplish, and how are you getting your fulfillment, and how have you approached this differently than you were before?
Yeah, so with HAAWK, we the first thing was, let's just be active, let's start a company. And I just was looking for cool names, and I found HAAWK with two A's .com was available, and it was pretty inexpensive because of I guess because of the misspelling. Though it is a 5-letter .com, it's a pretty decent little domain. So we just bought it. It was like, it could be anything. It could be, it could be it could be a rights management business, which it actually is, or it could be like a tool company. I don't know. It could be anything, right? It's HAAWK. It's kind of a cool name. So we started with just like, let's get a name, let's get a little office, let's get out of the house, let's get off the couch, and let's build some things. Let's tinker. Let's throw all the ideas we've got. So my co-founder and I did that, and we ended up, after, just some time, as well as just also just trying to get our sea legs, we just decided, believe it or not, to pretty much enter a similar space that we had been in. We didn't have non-competes, which is crazy. And I know
No kidding.
you're going to think I'm like some master of negotiation, and I'm not. The reality of it is the buyers didn't ask us to sign non-compete agreements at the time of the transaction. They just
That's
simply did
crazy.
not.
That's
And that was
crazy.
more of an oversight, in my opinion, on their behalf than wasn't it some clever thing we did or anything like that. And so we were able to just be in rights management again. And so that was where HAAWK started. And it's doing a lot of things differently. But at its core, it does rights management for social video platforms, including YouTube and Facebook.
Are you approaching, going through the whole 360 of the entrepreneurial journey? And now that you're doing this and you don't, you've gotten a windfall of capital gains, are you approaching the operations differently, who you're working with differently, because you've got this, very solid freedom of choice?
Yes, to an extent. A few things are different where I'm playing a little bit more of chess than checkers, and I'm I'm trying to use my time and go after the deals that make the biggest and most important moves and strategic moves, rather than just sort of small jumps. Um, so there's some of that. I used to take everything ungodly seriously. Like, just the smallest thing was like the world was on fire, you know? And it could be anything. And I was just like, I got to get to this email. I got to write back to this. I got to get this contract out. I got to do this. I got to, like, everything needed to be done fast, on nights, on weekends, all the time. And I realized, having, after selling it, like, it's, you need to spend, it's the 20% of your time is actually really high, it makes up 80% of the value. It's the old 80-20 rule. And like, if you just focus on the stuff that's that 20% most important, that makes up 80% of the value, you're going to be a lot less stressed. And that's kind of how I'm playing it this time around. It's the best way to say it. It's like, I just don't take it as seriously. I've been through enough deals and transactions to where, like, the email can wait until Monday. That thing, you can get back to that thing later, and you're not going to lose it. It's like, the world is not on fire all the time, and you don't need to stress over it. And so I'm trying to take that approach. Obviously, I still sort of sometimes can slip back into the old way, but much, much better at it. Taking care of myself first, like making sure I get my workout in every day I can in the morning before I go in and, get to what's on, the company's to-do list. I'm just making sure that those things come first and that family comes first. I'm making sure I'm home for dinner time. I'm there through bedtime. If I need to get to something, I can get to it in the evening after that, you know,
Hmm.
like, just chunking it up and taking more strategic approach to everything versus the past where everything was a fire. Everything had to be responded to quickly. It was on 24 hours a day, all on weekends, on holidays, on vacations. And it was just bad because all that stuff just wasn't adding a lot of value, and it was cutting into, like, myself. And so I just wanted to be happier in, my day-to-day approach to things. So
I think that's pretty solid advice. I mean, having balance as an entrepreneur is tough, and realizing it when it's not too late is the key part. Yeah. As we're wrapping up here, Ryan, your stories are awesome, and there's so much context behind it. And I think if we talked about a lot, if there's one thing that you want to maybe highlight on some of the stuff that we talked about, or if there's something that we maybe missed and you wanted to leave our listeners with, what would it be?
Well, one thing I like to tell or, say to folks that are thinking about entrepreneurship is, you've got to get on the field and try. You are not going to score a goal if you're not on the field. And I think for a lot of people, they say, I'd start a business if only I had the savings, or I'll start a business once I'm married and settled down, or I'll have a kid once I'm settled down and have my company. Like whatever it is, it's like it doesn't work like that. Like you just have to get out there and do it. I think a lot of the success that I've had is simply because I tried. Period. I was in the game, and therefore I had an opportunity to put the ball in the goal. If I never got off the sideline onto the field, warmed up, stretched into the first quarter, whatever it is, I was never going to actually make a basket or win a championship or whatever you want to call it. It was not going to happen. And I think it's just all about trying. I think a lot of folks that want to be entrepreneurs or want to be successful don't even take the step of trying and getting on the field. So I would just simply say to those that are looking to start businesses or have an exit one day or dream of these things happening or raising money or whatever it is, you've got to get out there and try. That is the first step. And for me, frankly, it was the most important step, because if I hadn't done it, if I hadn't said, I'm not going to take a paycheck, I'm not going to put some, savings into this thing, and I'm not going to just try this thing out of my apartment and, write the first check for the first developers to write the first lines of code and, start making cold calls and getting composers and getting music into the platform. If I didn't do that, none of that stuff, trying the tattoos, the cartoons, the voicemails, all the silly things, to the finally, the YouTube rights management, AdRev taking off, it wouldn't ever happen.
I think that's some of the best advice that we've had on the show. I mean, it's because you just got to do it, and because you don't get really two tries at this. At life it is, and I think you articulated it really, really well. If people want more of that and wanted to reach you after the show, what's the best way?
Yeah, so easy way is go to RyanBorn, RyanBorn, just like the day you were born.net. So go to RyanBorn.net. If you want my contact info, click on the About link at the top of the page. And if you read that page, you will find my personal email and my phone number. You can also tweet at me at BornRyan, that's BornRyan on Twitter. And you can find me. I'm definitely findable. So, I'm happy to have people reach out, but I make them do the teeniest bit of work, which is to go find my contact info.
I love it. Ryan, thanks so much for coming on the show, man. I had a blast.
Thanks for having me, Ryan. I appreciate it very much.